Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Now we're going to find out why a financial company, well-known financial company, and a technology company made the grade to be on this week's top picks list. And who's going to tell us about it? Nina Mishra and Brian Hamilton are here to give us those reasons why. Nina, we're going to start with you with Goldman Sachs.
Yes. So bank stocks have been doing pretty well since the election in anticipation of higher interest rates and faster economic growth.
Deregulation.
And deregulation. And on Friday, bank stocks surged after President Trump announced a review of Dodd-Frank regulations. And Goldman is seen as a big winner if some of these regulations are rolled back.
And for people who don't know the connection, they are an investment banker.
Yes.
Correct?
Yeah,
okay.
Right. So Dodd-Frank rules and other regulations imposed on banks in the aftermath of the financial crisis, they have no doubt improved the health of the financial system a lot, but they were also very costly. And if we look at the banking system now, the financial system now, they have come a long way since the financial crisis. Their balance sheets are much healthier. They have really improved their risk management systems. They're very well capitalized. In fact, most banks hold capital in excess of regulatory requirements now. And there's a story in the journal, Wall Street Journal this morning that top banks, including Goldman Sachs, could return up to 100 billion in capital to shareholders in the form of dividends and share buybacks if some of the regulations are rolled back.
And this morning, today's date, February the 6th, for those people following on the calendar. So the thought process here is let's deregulate these banks a little bit in the hope of getting more money back
to the businesses,
and
to shareholders.
Right.
So that should be good for investors. Goldman reported last month beating both on the top and bottom lines, mainly due to a surge in trading volumes and cost cutting. And in fact, if you look at their price consensus and EPS surprise chart, it looks pretty good because they haven't, they have missed only once in the last 5 years. That's a beautiful chart. And of course, shares are trading at record highs, not seen since the financial crisis. But if you look at their valuation, trading at a forward PE multiple of 12.3, they don't look too expensive. That's because those shares have surged after the election, but looking at the longer term picture, bank stocks were beaten down for last 8 years. So that is why financials are still one of the cheapest in terms of valuations within all S&P sectors. It's Zacks rank number 1, strong by stock, and if you look at the industry and sector rank, they are top 8% and top 6% respectively. So that also suggests some outperformance in the time to come.
Yeah, as a matter of fact, from what I read, Goldman has outperformed its industry classification over the past year.
Yes, they have been doing pretty well, and they should continue to do well.
Going forward.
Yeah, going forward as well.
All right, Brian, you are excited about Logitech.
Yeah, Logitech, they make your mouse, keyboard, the camera in your computer. And as of late, management has been really focusing on 2 things: cost containment and what you call it, strategic acquisitions. And this has massively paid off. They just reported earnings where they posted their 16th consecutive beat of the Zacks consecutive earnings estimate, which is absolutely crazy. They saw double-digit gains in almost every product they sold. Overall, in retail sales were up by 12%. Now, mind you, this is during a downswing during a tech environment. This just goes to show you how well the synergy is working with their acquisitions and their cost containment. Now, this isn't just isolated to the Americas as well. Europe is seeing double-digit revenue growth, and so is Asia Pacific. which is absolutely incredible for the company. And I really want to show you guys 3 charts that really give you a good feel of how these guys have been doing. The first one we're going to look at is your price and EPS surprise. As you can see, the green arrows here, your 16 consecutive beats. Now, they have been kind of mulling around here, but this is when they started doing their strategic acquisitions and their cost containment, and this started to really build up here as we're going through here. You can also see this in a comparison between, you have LOGI here and the NASDAQ. The NASDAQ has grown 30%, while these guys are up over 90% over the last 6 months. And again, it's showing you the synergy and how these acquisitions are working well with this company. This has not been missed by analysts by any stretch of the imagination. As we can see here, we got the muddling as we were seeing on the beats, and the estimates going sideways. But here, right when the acquisitions really start paying off, you see the jump in price, and you see the estimates for 16 and 17 on their way up. So these guys are also, because of all this good news, management increased guidance for fiscal year 2017 for their sales, which is expected to be between 12 and 14% above these already massive beats. So the expectation for 2017 for these guys is exceptionally high, but given what management has done as of late, it's understandable.
All right. Well, you can't get more excited than that, can you?
No?
Do either of you own either of these companies?
I do own Goldman Sachs.
In your own portfolio?
Yes.
I do not.
Okay, well, thanks for that. And don't forget, you can take a look at more stock information on our website, Zacks.com, not only on these 2 companies, but a lot of others as well. And all you need to do is get over to the homepage, Zacks.com. It all starts there, linked to a lot of information right from that page. With Nina and Brian, I'm Terry Ruffalo.